Hey everybody, this is Greg Gossett, and today is June 11th, 2022, Saturday. Thank you so much for coming and visiting the Gossett Trading and Mentoring Weekend Review Update podcast. Hope you're having a good weekend. Boy, what a week last week in the market. It's pretty crazy. I hope you're staying safe out there. Hope you're following your rules. Been pretty volatile, trying to make sense of it all. And but last week actually wasn't too bad of a week for swing trades, and mainly because of my trailing stop methodologies, and I'll go ahead and show you those today. I was able to get out of a lot of positions before the big drop down on Thursday and Friday, so I'll share those with you. So the plan for today, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to go through my daily swing trades, talk about when I bought them, why I bought them, if I'm still in them, how I am going to manage them going forward. I also have some trades on the weekly charts that we're going to go over, do the same thing, and then also one on the monthly charts. I do like to trade a variety of time frames. I like to trade a variety of different trading approaches. I like to trade a variety of different type of stocks. I think it's very important using different time frames, different type of equity, so you're not highly correlated in one particular type of equity. I like to get outside of equities, bonds, gold, silver, dollar, so forth and so on. And I like to trade different types of strategies. So different strategies that I've used that we're going to go over here. So, but first of all, like I said, we're going to go through my current positions and closed positions, talk about when I bought them, why I bought them, and how I'm going to manage them going forward. If I still have them, then we're going to talk a little bit about trader psychology. Very important. I've been saying this for the last 2 months, but in this kind of market where emotions run high, get amplified because of these moves and the volatility, it's a good time to always take a few minutes, reflect back on some good trading words of wisdom on trader psychology, and that's what we're going to do as well. After that, we are going to read a poem from my good friend Frank, who is the trading poet, always apropos about what's going on in the market, and I found a really good one that I want to share with you. After that, I have gone down through my watch list. I've gone down through the watch list, each stock one by one, checked off the ones that could be potentially interesting for me next week. Generally, a stock has to go lower, find some support lower, or go higher, maybe some momentum to the upside. But I have identified, what do I have? It looks like I have 21 symbols here that we'll go through. And I do have the indexes as well, so we can kind of get a bigger picture on the market as well. But we'll go through each one. I'll tell you what I'm looking for, and hopefully that will be helpful for you and hopefully helpful for me again next week as well. So that's the format for today. I do have to run the U.S. legal disclaimer, so hang tight. It's going to be about 40 seconds, and I will be right back after that. Thank you. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much. Okay, thanks for hanging tight with me, and let's get started. Looks like the only day position that I have open right now is Amazon. So I did buy Amazon, really nailed the bottom on this one, which I'm grateful for. Bought this back on 5/24/22. What was the signal? The signal was a intraday. The price went under the 30 RSI intraday and closed above. Also was a higher low under 30 over 30. This one went under 30 as well, but this one came from a higher low situation. So I did enter here at 104 even. I placed my emergency stop, which is always 2 ATRs below my entry point. Also My end of day stop is very important. What's the end of day stop? End of day stop is the opposite of why I took the trade. Why did I take the trade? Well, because it went under 30 over 30. So I have my emergency stop 2 ATRs below. And then I also have my end of day stop, which is an under 30 over 30. So if the next day, if it had closed below 30 RSI, I would have gone ahead and hopefully just taken a small loss, right? That's the idea. But we nailed it. We nailed it here at 104. As you know, whenever the price moves at least the value of 0.45 ATRs from my entry, I do take partial profits. I take 10% off of whatever the core position is that I have. So I bought here. The next day it moved up more than 0.45 ATR, so I took 10%. This bar up here went, that could have been 2. I think I got 2 profit targets on that. So 0.45 and then the 0.45 above that. It kept moving up. I always scale out of my position into strength, right? And then up here, oh, this line here, I had this wrong, sorry. So we made it to 1.5 ATR trailing stop level. So we have our entry point. I have my 1.5 ATRs above. When we move that level above, then I go into trailing stop mode. So here we got into trailing stop mode about here. Here I have my first close below the previous day's low. That is my signal to go ahead and get out of half of the position. And I did that, what was that, on Tuesday at 122.82 it looks like here. So that was a big gain, 15.5% gain, but I did not take the entire position off. I only took half of the position off. Now, had it gotten above a 65 RSI level, then as soon as it lost the 5 EMA, I would have gotten out of the rest of the position, but it didn't get there. And in the trading psychology section today, we're going to talk about regret, following your rules, not following your rules. Well, this was a bummer. I didn't like that we closed below the 5 EMA, but my rules called for me not to take the profit because we didn't get to 65 RSI. So I still follow the rules on this one, but it was hard to take this loss down and give back a lot of the profits. But on the bright side, I did sell half up here, which really helped, right, with the close below the previous day's low after reaching 1.5 ATR trailing stop level. And I took a lot of profits on the way up here. And that's what I really like about my trading approach. I take partial profits when the market gives them to me. I have rules to get out if we get to certain levels, then have closes below the previous day's low. But in this particular trade, I still have the half position in Amazon going down here. Now, if it got to my break even point, I would get out of the rest of the position. If I ever take an under 30 over 30 and it moves up to 1.5 ATR trailing stop level, which it did, and if it ever comes back down to my entry point, I would get out of the remainder position at break even. I'm not going to let this huge gain turn into a loss, even though the second half of the position I did give this back. But boy, did we have some brutal days on Thursday and Friday. But anyway, still happy with the Amazon trade. Really glad I got out of half. Really glad I took profits when I had them on the way up. And the way I'll manage this trade going forward is, of course, if it moves up 0.45 ATRs from yesterday or from Friday's close, I will take more profit targets off, partial profits off. But because this was an under 30 over 30, if it gets back to my entry point, I'll just go ahead and take half. Take a scratch trade or a break-even trade on that second half. And you know, this particular podcast, it's kind of big picture. I go over what I'm doing. You know, there's a lot of rules with my trailing stops. I don't really have time to do you know, an in-depth dive on all the rules, but and I'll talk about this later at the end of the podcast. But if you are interested in private one-on-one lessons, I do teach them in the evening time via Skype. It's a great course. It's 15 hours. It's just you and I. I teach you all 5 of my trading approaches step by step. So if you're interested, all you have to do is send me an email. Let me know you're interested, but I will talk about it more at the end of the day. So anyway, that's Amazon. Locked in 15.5% profits on the first half, thank goodness, and then still profitable on the second half here. I guess we should see how much. Still profitable 5.26% on the rest. Okay, CCJ. CCJ was a great trade. took this back here on the May 23rd. What was the signal? Well, there were multiple signals. I like to take multiple signals. It was a close under the 200, close back over the 200. That was one. We also took out a fractal, the high of a fractal. A fractal is a high point with two lower highs to the left, high point with two lower highs to the right. So that was a confluence of signals. Close under 200, close over 200, took out the fractal. MACD was also positive, which made this good. My end of day stop, well, first of all, right, whatever I do, I position size first. And actually, I guess I should have talked about this on Amazon, but let's just go through the rules of position sizing. A good rule of thumb is 1% of your total trading capital. If you have $100,000, 1% is $1,000. If you have $50,000, 1% is $500. So let's just go ahead with a hypothetical $100,000 account. 1% of that is $1,000. That's your maximum allowed loss, the maximum, right? So what do? I take the 1% of 100,000, which is $1,000. I divide it by the value of the 2 ATR, divided by 2.53. So that takes into account the volatility of the market. If the volatility is higher, it will have this number will be larger, and it will have you buy fewer shares. If the volatility is lower, that number will be smaller, and you'll buy more shares. So I love how it just automatically adjusts for the volatility. So anyway, I took 1% of my total trading capital in this hypothetical. 1% of $100,000, $1,000 divided by the value of the 2 ATR. That tells me to buy 395 shares. So that's how much I buy. I placed my emergency stop. Where do I place my emergency stop? I place it exactly what the value is of the 2 ATR, 253, below my entry. Therefore, if it gets down to my emergency stop, I lose that $1,000 or the $500 or the $250, depending on what you started with total capital. Now, that only happens about 5% of the time. 95% of the time, when you get out with a loss, it's going to be a loss with a end of day stop. Well, why did I take this trade? Close under 200, close over 200. If it had closed under 200, I would have gone ahead and just gotten out. And the key word there is closed. The next bar, the next day, you can see it did go under the 200, but it had enough strength to stay above the 200, so I kept it. Had it closed below the 200, I would have gone ahead and just gotten out. So anyway, entered here at 24.04, under 200, over 200, break of the fractal. MACD was positive. It held the 200. As usual, if it moves up the value of 0.45 ATRs from the previous day's close, I take some profits. So no profits here, no profits here. There was profit here, there was profit here, there was profit here. There were 2 profits here. There were like 4 profits on this big, huge day. Next day, we had 1 profit target. So that's the advantage of taking profits when the market has them. Right now, orange line here is 1.5 ATRs above my entry. That's where I go into trailing stop mode, and it did get above there. It also got above the 65 RSI. If I ever get above the 65 RSI and then I have a close below the 5 EMA, I take the entire position off. So got in here at 24.04. I got out at 26.18 because it went above the 65 RSI, closed below the 5 EMA, got out, locked in a 7.92% position on CCJ. SO. All right, so this one was a loser. Very happy that I took some profits when I had them. Good example of why I like to do that. 520 crossover is why I bought the trade here on the 16th of May. Bought it at 74.60 with a 5 EMA crossing over the 20 EMA. Went up, down, up, no real profit targets. Did take some nice profit targets on this one here. I believe it was 2. Took one here, took one there on the day that I got out before the big plunge. And then we had the 5 cross under the 20. That got me out of the trade. So I did lose 2.38% on this particular trade. But all in all, really, I didn't lose that much because I didn't hold the whole position, right? I took profits when I had them. And you can see emergency stop down here with the position sizing, Orange line up here, 1.5 ATR trailing stop above my entry. Never got there, so none of these closes below the previous day's lows came into play, but we did have the 5 cross under the 20, and I got out for a loss of 2.38%. All right, Netflix. This turned into be a really good trade, and really glad that I got out. Why did I take the trade? Well, here we have an under 30 over 30. That was my initial entry into the trade. What's the purple line down here? Yes, that's your emergency stop. That's exactly the value of 2 ATRs beneath your entry price. End of day stop, well, I took it with an under 30 over 30. So if I have a close below 30, that's my stop, but it never took, right? It always held the 30. So I bought this here, went up, came down on me, backfilled a little bit, consolidated, moved up. As it moves up, I take partial profits. Orange line here, what's the orange line? That's 1.5 ATRs above my entry. So then I'm in trailing stop level, right? Which means if I get a close below the previous day's low, I get out. Well, that happened here on the 6th with a close below the previous day's low. What did I do? I sold half for a profit of 5.23%. And then 3 days ago, we went above 50 RSI intraday and closed below it. That is my second reason to get out of the trade. Whenever I take a trade with an under 30 over 30, then I will get out of half if I get a close below the previous day's low after reaching trailing stop level, or if I reject the 50 RSI above me, I also get out, or if I reject the 50 SMA. And if two of 3 of those happen, then I'm completely out of the trade. So under 30 over 30, bought the trade. It held the 30. As it moves up, I'm taking partial profits as always. Got to trailing stop level, had a close below the previous day's low, sold half here, 197.20. Came down on the 8th. It went above 50 RSI, closed below 50 RSI. That is the reason to get out of the rest of the trade. Remember, 2 of 3 of those I get out, and 2 happened. Closed below the previous day's low after reaching trailing stop level. And then on this bar, we rejected the 50 above. That was also my reason for getting out. So hope that makes sense. So half of the position made 5.23%, and the other half made 8.04%. So good trade on Netflix. Okay, so those are the daily trades. Let's go to the weeklies. All right, well, this one turned out really well initially, and not so hot tamale because of the big move we've had. So this is a weekly trade. Take these trades, make my decisions on Friday. Here we rejected the 200-day moving average. I bought at 177.80. Next week went down, but closed above the 200, so I stayed in the trade. Next week we had a big move up, did hit some profit targets, took some of the profits I had off, not all, but partial. Next week was an inside bar. This last week moved up, no profit targets, had the big move down. Now this did close below this low. This bar closed below the previous day's low. So do I get out of half? I don't, because I never got to my trailing stop level here at 194.50. So it is still holding above the 200-day moving average. I'm still in the trade because of that reason. I'm glad I took some profits when I had them, partial profits. But this particular trade now, after being up, I can't remember, 6% or something like that, is only up 0.54%. So kind of a bummer, but still glad to be positive on the trade. Alibaba, another nice weekly trade. Very happy for this one. Took this one back on 527, lower high V1 into the value zone. Again, I teach these in my lessons. I also have a some free lessons on YouTube in the lessons and playlist videos where I talk specifically about V1s, V2s on my YouTube channel. Check it out. V1s, V2s, big part of my trading. But I did take Alibaba on Friday at the close of the bar at 93.03. Next week went up a little bit, not enough for a profit target, came back, was at about break even. Last week we had the big move up, and it rejected the 50 RSI. It went above the 50 and below the 50, so I did take half profits 14.79. Now, if it gets back to my break even after reaching my trailing stop level on this particular type of trade, I will go ahead and get out at break even. But nicely, this trade is up 14.79%. All right, lastly is Home Depot. So I did buy Home Depot on the monthly when we had this return to value. This green line and this green line is the value zone. We returned to value. We went sideways. We went sideways. I'm looking for that sideways motion. That sideways motion shows me that there's an equilibrium there of buyers and sellers. That's why it didn't continue to keep going down. But then, so above the value zone, into the value zone, sideways motion. Here we had a V1. Essentially what a V1 is two bars. You have bar 1, you have bar 2. Bar 2 goes below bar 1, closes above bar 1's close. Entered here 307.41. And right now it's 289.47. So I am down 6.5% on this particular trade. My end of day stop on this particular trade is a close below halfway of the washout bar. The month is not over. It's below the halfway now. So if this was the end of the last day of the month, I would have gotten out, but I didn't because it's not the end of the month. And then down here, we have the emergency stop. I always have the emergency stop. I always have the end of day stop. Or end of week stop, end of month stop. I also have my trailing stop level if it gets up here, not anywhere close. So this one down 6.5%. So anyway, not bad. Glad I got out of some things when I did get out of them. Very happy for that. And so let's head over, talk a little bit about trading psychology, shall we? This is from Pips Wind at Pips Wind over on Twitter. Great channel. I really like this because it really reminded me this week of my trading. We, as traders, have a choice between the pain of discipline and the pain of regret. So this is extremely true, and it cuts both ways. So having a choice between the pain of discipline and the pain of regret. What is the pain of discipline? The pain of discipline is when you have a process, you have rules, and you follow it. So I'm in a stock, it hits my stop, I have to get out. The next day it goes ripping back up, and I'm like, why did I do that? Why did I get out? Well, I got out because my rules told me to, and that's what the pain of discipline is. It's going to happen to you a lot. What is the pain of regret? Well, the pain of regret is when you don't take your stop when you were supposed to, and it goes down. It's happened to all of you, I'm sure. So sometimes you're going to follow your rules. You're going to get out with the loss. It's going to take right back off, and you're like, why did I follow my rules? Right? That's the pain of discipline. But the pain of regret is when you don't follow your rules and you don't get out and it keeps going down, and you're like, why did I not get out? So it's never perfect. It's never perfect, but really it is a lot better to have rules and a process in place. And regardless of that, you are going to have pain with that, but it is going to help you. When I was in my early 20s, I had I never really used stops, and it worked out fine until the one day where I have two stocks that went to zero, right? So I know of what I speak here. I've been through it. Very, very interesting kind of stuff, but I really like this. Please support at Pips Win. This was a great post. We as traders have a choice between the pain of discipline and the pain of regret. So thank you very much. Great post. All right, let's head on over here. Take a look at the, this is from my buddy Frank at Franco D. Please support Franco D over on Twitter. Today's market poem: be patient, and the market will come to you. You can't force a chart to have a beautiful view. A good trading strategy will give you its cue. Uncertainty just makes a market stew, which is essentially what we have now. So let's read it again. Be patient and the market will come to you. Very important. Let the trade come to you. You can't force a chart to have a beautiful view. If it's a bad chart, it's a bad chart. A good trading strategy will give you its cue. Entry, setups, right? Uncertainty just makes a market stew. So true. Thank you, Frank. Please follow him over at Franco D. All right, so like I said, I did go down through my watch list. I have some potential stocks to look at. I usually like to pick the stocks that look to me like they're going to be likely that something's going to happen next week. A lot of these are not super close, but the market's been so volatile that with the volatility, it could certainly get there. So that's why I wanted to go over and take a look at this. Start off with Apple, AAPL on Apple. Well, we did have a nice trade on Apple on this bar here, about 137, under 30, over 30, rode it up, got out when we had closed below the previous day's low here, and lost the 50 RSI, I believe, and that's why we got out of the trade. This is what happens a lot. You get these deep dip buys, you come into the value zone. In the value zone here, a lot of times you just move sideways, you consolidate. It will then either take off to the upside or will consolidate and move to the downside. Unfortunately, that is what has happened, obviously, with Apple. It's been a hot mess. But next week, what am I looking for? Well, we're at 3706 RSI. If we could come down and test these lows down about 133. I hope not, but we could. And if we did, we would have a beautiful double bottom with a bullish divergence. Here, this move down here has the deep red MACD bars. Then we rally to green. Now we're on the way back down, but you see how even though we're on the way back down, we don't have any red. So even if we get to this low, if we match this low, then we will have a double bottom with the bullish divergence because we won't have as deep red on this move down as this deep red here. So even if we get a double bottom bullish divergence, I still need a trigger. Trigger would be a V1, V2, under 30, over 30. So really what I'm looking for here specifically is some kind of V1, V2. If we get down here near and test this low, the market's probably dragging it down to test that. Or alternatively, if we just get an under 30, over 30, that would be the legitimate entry signal with a decent risk to reward ratio. Keeping in mind, we still have to position size correctly and so forth. So, but what would be better? A V1, V2, and an under 30, over 30. Confluence, combination of indicators, the best way to do it. Okay? So that's Apple looking essentially for a retest of this previous low and or under 30, over 30. Both of them together would be the best. Actually, I can measure this. Oh, no, sorry. I can measure this to give you an idea. Oh, yeah. That's going to be way down here. Depending on how far, how fast it gets down there, RSI would be about, price would be about 127. 20. That's the under 30, over 30. And then we would have a beautiful double bottom bullish divergence depending on how fast it gets down there. So just to keep it simple, everyone, what I'm really looking for here is an under 30, over 30 on Apple. Bitcoin, well, very similar to Apple. Here we have this low with deep red MACD bars. If we rally into green, which we did, if we come back down here, test this low, we'd have a double bottom, triple bottom, actually, with a double bottom bullish divergence. But what I'm really looking for on BITO is an under 30, over 30. Berkshire Hathaway, well, look at this. We just went cranking through these moving averages like a hot knife through butter. Went right through the 200, lost it, lost the 250, lost the 300. We have a beautiful double bottom bullish divergence. This is a good example. Look, here's our low and the move down that created the low. Look how deep these bars are. Then we rallied into green. Yes, we did. We are now lower than this low. So, and you see the depth of this red here? It's red, but it's less than half of the depth of this red. So this is a double bottom bullish divergence. We just need an entry signal. Well, look, we're at 29.69. So Monday, if we closed above the 30 RSI, that would be an under 30, over 30. At the same time, we have a double bottom bullish divergence. We're also down here at the negative third ATR channel. 92% of prices tend to stop going down at the negative third ATR channel. So there's a lot of things here. This is probably my most favorite trade for next week if we get a close above the 30 RSI. Carnival, well, we have a double bottom bullish divergence. Here's the low, deep red MACD bars. We rally to green. We are now lower than that previous low, but you see how the red here is not very deep? That's a double bottom bullish divergence. Then we need a trigger. Well, we're at 30.58 right now. So we're right there. It did hold the 30 RSI. It's near the negative third ATR channel. So if I get an under 30, over 30 next week, in addition to the double bottom bullish divergence and being at the negative third ATR channel, that's when I would look to buy that. Keep in mind, we do have earnings on the 22nd. So I never hold through earnings. So if it happens on Monday where we go under 30, over 30, I'll probably buy it, but I'll have to get out before earnings since I don't hold through earnings. Concert Pharmaceuticals. I talked about this before. They have a new drug that brings back hair in about 40% of people, which is pretty amazing. You can see the stock went from 273. It tripled, more than tripled in about 2 months' time. Had a pullback, which makes sense. It's reasonable. We're back into the value zone. Here's the screen line. Here's the screen line. Anywhere in here is the value zone. So it came down into the value zone, rallied a little bit. Am I going to buy it right here in the value zone? I might if we were to undercut this low, then have a V1 or V2. But really, for the purposes of this podcast, what I'm really looking for would be a nice, I always talk about letting the trade come to you. Let the trade come to you down at the 200-day moving average. Will it get there? I have no idea. It may not. I do have tools available that if we keep going sideways here and have a V1, we might get a rally back up to the high. So that's one potential, but a little harder for this podcast for me to explain. But if we get a nice rejection of the 200-day moving average, I'll buy it. I mean, look at the last one. We closed under the 200, over the 200. That would have been a legitimate entry. And look what happened. I mean, not all under 200s, over 200s happen like this, but at some point that went up 98%. Holy moly. So be patient. I would be patient. I'm looking for a return to value, sideways motion, V1, V2, or alternatively, easier one here, but with more patience, rejection of the 200-day moving average to give me a good risk to reward ratio at a good support level. All right, here's the DIA. This is the Dow Jones. We're at 37.49. We're not at under 30, over 30, but we may possibly come down and test these lows. And if we did come down and test these lows, MACD would be red, but it would not be as deep as this. So we would have a double bottom bullish divergence. So it's just my own opinion. You never know what's going to happen. You have to prepare for everything. But if we do come down, make a low here, we'll have a double bottom bullish divergence but we still need to trigger an under 30, over 30. So we're at 37.49, long ways away from 30, but with this kind of market, wouldn't surprise me if we actually did come down, test these lows, go under 30, over 30. So I'll be looking for an under 30, over 30 on DIA next week. Walt Disney, well, here we go. This is a good example of a current double bottom bullish divergence with a triple divergence. Here we have a low. We rallied to green. We came back down. That low did not have any red bars. So that's a double bottom bullish divergence. And it did move up nicely, moved up nicely. Now we're down at the equal these lows, and there's still no red. This is what Dr. Alexander Elder calls a triple bottom with a bullish divergence. 33.25, looking for an under 30, over 30 to trigger me in long on Disney. DocuSign. Nothing here that I want to show you other than holding through earnings. If you bought through earnings here at 87.55, you would have woken up with a 24.53% loss on your trade just by the fact that you held through earnings. Holding through earnings is one of the most dangerous things you can do. Yes, you can make a lot of money quickly to the upside, but you can also lose a lot of money quickly. It's just basically gambling, hoping that the earnings are going to be good. Even if they are good, the stock could go down. You see what I'm saying? So your job as a money manager, number one, first off, is to protect the capital that you have, and holding through earnings is the worst way to protect capital. So I saw this here when I was going through the charts, just wanted to point that out. Now, on the bright side, we are close to testing this low over here, deep red, no red over here, but you would still need a signal under 30, over 30, but I don't like taking signals after a big, huge crack down like this. The reason I'm showing you this here is just what can happen with earnings. FCX. All right. Well, look at this. We had a nice under 30, over 30. It took us way up. Then we had a pullback into the value zone. Next week, if we get a close above the 200-day moving average, it gives me a good risk to reward ratio at a strong support level. Doesn't mean it's going to work, but it gives me a good context, using technicals, a good context and a good structure to set up a trade with a good risk to reward ratio. So that's FCX if we get above the 200-day moving average. Gold. Okay, so listen to this. We had a beautiful rejection of the 200-day moving average here. Just beautiful. But would I buy this? I'm not going to buy it. You see how far we are away from the 200-day moving average? Like, this one would have been great here. I should have bought this one, actually. Shoulda, woulda, coulda, right? But it had a intraday rejection of the 200-day moving average. It opened up way down, moved right back up. So yeah, I technically could buy this with it over the 200-day moving average. But you see the distance between here and the 200-day moving average just doesn't give me a good risk to reward. This one gave me a good risk to reward, right? Because if it just closed gently below the 200-day moving average, I wouldn't lose much. But this one is so far high above the moving average and a lot of volume, which is good. But I wanted to show you this to show you that you have to have good risk to reward ratios. This one is not a good risk to reward ratio. If we were to come back down, reject the 200-day moving average again, that's what I would be interested on gold. And we did have 520 crossover on gold here as well. Not bad. Didn't take this trade, but that is also a legitimate trade. Goldman Sachs. Oh my gosh. Look at this, everyone. This is brutal. I mean, look at this move up and look, there's an old saying. You take the elevators up. You take the stairs up, nice and slow up. And then you take the move back down is the elevator, very quickly down, and that's exactly what happened. This is Goldman Sachs, quality company. Next week, it's 31.88 RSI. If we go under 30, over 30, then I would be potentially interested in buying Goldman Sachs with an under 30, over 30. So that's something I'm watching next week. Microsoft. Well, a great company like Microsoft that's 34.20 RSI. Potentially we come back down here, test these lows. It would also give us a double bottom bullish divergence, but simply put, next week, what I'm looking for next week on Microsoft is just an under 30, over 30. Pfizer. Well, we had this beautiful move up on Pfizer. Really, really nice. Had a pullback. This one's likely. It respected the 200-day moving average last time and moved up nicely from the 200. Will it happen this time? I don't know. But if it does reject either a close under 200, over 200, an intraday rejection of the 200, or a bounce of the 200, and it doesn't move too far, meaning the risk to reward ratio is not too high, not too chasey, I may be interested in buying Pfizer next week. Qs. Well. Again, similar to SPY, similar to diamonds, we could come back down next week, test that low. We would have a double bottom bullish divergence. What I'm looking for is an under 30, over 30 RSI next week on Qs while it has a double bottom and bullish divergence. Will it get there? I have no idea. It's 38.87, but it's potential with this type of move down. It is potential that we could get an under 30, over 30. Under 30, over 30s are really good entry points on the indexes as they were here and rallied, right? On this one, rallied. So will it do it again? I don't know, but I like that we have the double bottom and bullish divergence in place. Rio Tinto had a beautiful trade. Look at this, close under 200, over 200, moved up nicely. If it comes back down, so there's three things I'm looking for next week. I'm looking for a rejection of the 300. I'm looking for a rejection of the 200, or I'm looking for a rejection, the 250, or I'm looking for a rejection of the 200. If it has a nice bounce, nice configuration of a V1, V2, or a good risk to reward ratio with an intraday bounce or a close under, close over, either the 300, 250, or the 200, that's the area that I would be looking for a bounce on Rio. SPY, very similar to the Qs, of course. Again, we had the big move down, big red MACD bars. We rallied, green bars showing positive momentum. If we come back down, test this low, it will give us a double bottom and a bullish divergence, and the trigger would be an under 30, over 30. It's 38.40. It's quite a long ways away, but you have to remember that just, a week ago, we were up in the 60 RSIs. Now we're at 38. That's the strength of this move down. So I would love to buy SPY with an under 30, over 30 on a deep dip buy. VIX. Well, VIX did come to life the last couple days, although it did sell off at the end there. That may be a decent sign for the market, but I don't know. But if we were to get a close above the 200-day moving average, I would buy VIX. I would buy VIX, and it's possible that the market's just going to continue down, and the VIX would probably continue up. So if I get a nice, easy close above the 200-day moving average, I would get in VIX next week. Walmart, pretty incredible. Walmart was up on Friday with the carnage in the market. Also went under 30, over 30, and also had a V1 entry. Here's bar one, here's bar two. Bar two goes below bar one, closes above bar one's close. That would have been a legitimate entry. I didn't take the position, but actually I didn't see it. I may have taken this on Friday because that's legit. V1 entry, under 30, over 30, gives me a good risk to reward ratio with the close below the 30 RSI or close below halfway the washout bar, depending which stop you pick. There are some trades where you have options of multiple stop levels depending on how you took it. There's pluses and minuses to both of them. Again, in the private lessons that I teach in my course, I go through all of this. But if Walmart does go under 30, over 30 again next week, that's where I'll pick up Walmart. XLF, ooh, man. Of course, financials, we looked at Goldman Sachs, and we've had this huge move down. We are getting into the support of the previous lows. It's 34.84. If we go under 30, over 30, that would be my entry. Real estate, hammered, just hammered. We know why, because of the interest rates and so forth. But look, we do have a double bottom bullish divergence right now. Here's the low, deep red MACD bars. We rally into green. We come back down. We are lower than this low, but you see the MACD, it's very shallow. It's not as deep as over here. That gives us a double bottom with the bullish divergence. So that's the setup. But what's our entry trigger? Entry trigger would be essentially an under 30, over 30 next week on XLRE would get me interested in XLRE, especially because of the double bottom bullish divergence. And lastly, healthcare. Same, very similar looking chart to XLRE. Here's the low, deep red MACD bars. We rally into green. We come back down. We've tested this low. Even though we've tested this low, MACD is not as deep as these bars. What does that mean? Why is that important? The depth of the bar shows the strength of the momentum. The momentum was extremely strong on this way down with very red MACD bars. Then we rally into green. Now we've come back down. This looks pretty brutal, but from a MACD standpoint, it was not, the strength of the move was not as strong as over here. So the implication is that you're running out of selling momentum. And I know it doesn't seem that way, but from a MACD perspective, the move back down here was not as deep as here, therefore the move was not as strong, and we may be running out of sellers, which would move it back up. So that's what I have for you today, everyone. I mentioned earlier, if you are interested in really learning all the steps to trade like I do, I trade 5 different trading strategies. I use emergency stops, end of day stops, profit targets, trailing stop levels, overhead resistance levels. It takes a lot of time, takes 15 hours actually, and that's why my course is 15 hours long. If you're interested in taking the course, my email is in the link of this YouTube video. Just send me an email. Say, Greg, I'm potentially interested in taking your course. I'll reply and say, hey, that's great. Let's get together on Skype. The Skype is a free call. It's not a sales call. I promise you that. I just want to be able to talk to a potential student, understand what they're looking for, talk about their trading goals, their trading challenges, what they're hoping to achieve. And it's a great time for the student to ask me any particular questions about the podcast, about the course. And then when we're done with the call, I won't contact you. I won't ask you if you want to take the course. You think about it in the future. If you decide, just email me back and we'll take the course. I've taught people from all over the world. I've had such good feedback. The course does cost $1,750, but it's worth every penny because I'm going to show you step by step exactly how I trade. I've been trading a long time, over 26 years now, and the course is worth every penny. I know you're going to like it. Number 2, if you like online trading courses, I have a great one on Udemy, udemy.com. The link is in the description of this YouTube video. I have a course called the Deep Dip by Stock Trading Strategy. I teach you step by step how to do that. The course is 9.5 hours, 26 videos, 15 study guides, and the best thing about that course, it only costs between $12 and $15. I sold so many of them around the world, got such good reviews, such good feedback. So if you're interested, just click on the link in the description of my YouTube video, buy the course for the 12 or 15 bucks. If you have any questions, feel free to come and post them in the comment section. And I think you're really going to like the course. And you can also answer questions on you. I can also answer questions for you on Udemy as well. So it's a great course. Take a look at it in the link in the description. And then lastly, if you like today's podcast, I would appreciate it if you could hit the thumbs up button. Helps keep the channel around, lets YouTube know there's some valuable content here. And so if anything was helpful today or last week, if you could hit the thumbs up button, I'd appreciate it. If you could share it on social media, I would appreciate that as well. So I always like to leave off, tell everyone, listen, if you went out and did one nice thing for another human being today, it really would make the world a better place. If you could also go out and do one act of kindness for an animal, they would love it, they would appreciate it, and it really would make the world a better place if we could do one nice thing for a human, one nice thing for an animal. And it's good karma. It will come back and help you as well. So keep that in mind. So anyway, don't forget about the course, the private one-on-one course that I teach. Don't forget about the online video course on Udemy, both in the links. Don't forget about hitting the thumbs up button. Especially don't forget about thinking about going out and helping someone, doing one nice thing for another human being. And then on top of it, please have a good rest of your weekend. Get some rest, get some exercise, do some breathing, do some meditation, and be good, be safe, and really appreciate you being here. And on the way out, I have to run the U.S. legal disclaimer. It's going to be interesting to see what next week brings. And next week, I will bring the podcast as well. So thanks so much. Hang tight for the U.S. legal disclaimer and have a good rest of your weekend. Take care, everyone. Bye-bye. U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.